weeks, we celebrated, seems like a lot of Jewish holidays. So I was with many friends and family, and a lot of people I spoke to had a general feeling of malaise, even morose feelings when talking about our economy, local politics, the upcoming election, the war in Ukraine. The list seemed to go on and on and on, like the world's on fire. Totally understandable. When I asked people what they were doing to counter the issues and their feelings, most of them were doing very little. So I was reminded of a great book that I recommend to everybody here by Stephen Post called Why Good Things Happen to Good People: How to Live Longer, Healthier Life by the Simple Act of Giving. The title tells you everything you need to know. According to several studies, altruism, giving, volunteering, having active empathy for others, and doing something good makes one happier and prolongs life. Philanthropy, says Dr. Post, doles out happiness chemicals. So really want to say is if you have clients who are grumpy right now or want to do something to help our community but aren't sure how to get started, or want to talk about trusted and productive nonprofits doing great work and they want to partner with them, call us. We spend our days helping people, help people. And I want to tell you, it's a wonderful life and a wonderful thing we do. And if we can help your clients or you have some of that wonderful feeling, we'd be happy to. So just to, again, a reminder, please send questions to me using the chat function, and we'll get to those at the end. For that, Allan, I'll turn it over to you, and thank you again for being here.
Okay, I did see the number of people who signed up, and the number of my peers who have signed up. So I'm a little intimidated. I hope I don't make any mistakes doing this. And I hope this is helpful and productive. What I have found over the last couple of years is that, you know, for most estate planning lawyers, the bread and butter of your practice are maybe trust and estates that are $5 to $10 million in value. As your practice gets bigger and healthier, it's $10 to $20 million in value. That's a lot of the work that we do. And what's happened over time, I believe, is that with the exemptions increasing the way that they have, you have what will be rather large estates with a certain assumption being made by the client for whom you've done the estate planning document. And the assumption is there's no tax and therefore I don't have to do anything. For those of you that have seen the new inflation numbers, in 2023, the basic exclusion amount is now $12,900,000, almost $13 million. That means for people that have a $26 million estate, if a husband and wife have a $26 million estate, there is no estate tax. And if you think about that in terms of the possibility of discounting values of certain assets, you could be looking at a $30 or maybe even a $35 million estate and have no estate tax. And I have sensed a growing tendency with clients to assume that they don't have to do anything, or more importantly, a reluctance to pay those jerky lawyer fees where they don't have any estate tax, because the assumption is if you've set up a living trust and there's no probate and there's no tax, why do I need to engage with a lawyer? And the problem is that things are not as easy as they may seem. Simply because there's no probate does not mean that there's no tax planning to do. Simply because there is no estate tax does not mean that there is no tax planning to do. And most importantly, perhaps in many cases, the tax issues are not limited to just estate taxes. Now, before I dive into my outline, and with great risk, because I've done this now twice during COVID, and I've been reluctant to tell any kind of jokes because I can't see the audience reaction, so I have no idea how I may be bombing. We're going to try one. So the important question in today's world may be, what is celibacy? And celibacy can be a choice in life or a condition imposed by circumstances. So with that, let me share a short story. While attending a marriage weekend, Walter and his wife Ann listened to the instructor declare, "It is essential that husbands and wives know the things that are important to each other." He then addressed the men. Can you name and describe your wife's favorite flower? Walter leaned over, touched Anne's arm gently, and whispered, "Gold medal all-purpose, isn't it?" And thus began Walter's life of celibacy. Okay, I got to work without an audience response. That's like without a net. So let's go forward on the outline at this point. What are the issues that may tend to be forgotten? Even though there's no estate tax, you may need to consider three things: the income tax basis of assets and the impact of that by not filing estate tax returns, a possible estate tax at the death of the second spouse, and the issue of portability and Q-tip elections. And again, keep in mind that a Q-tip election is simply a marital deduction election that's made in an estate, but you got to file an estate tax return to do that. Portability covers the issue of the ability of one spouse to port or transfer any of their unused exemption to the surviving spouse. Those issues are important to deal with, and I'm going to address kind of what you confront in your normal practice in a moment. But there are also some income tax issues that need to be dealt with. You have the issue of 754 elections. I've gotten a few comments that either happy faces laughing or a note that somebody laughed, so I'm encouraged to go forward, and I do have one more left, but we'll save it. You have 645 elections in terms of filing a trust return and a estate tax return, and how do you best, is it advantageous in some cases to make an election to file a fiduciary return for the estate? In some cases, you may have 642C elections with regard to charitable deductions, and you have issues with respect to sub-S elections and other tax-sensitive elections that you need to be aware of. So having said all of that, how does this happen in a practical case? Well, there are two ways, I think, that we confront this. The first way is when the client comes in and says, here's our estate. Now, in many cases, when we draft a husband and wife estate plan, what the typical plan, more often than not, is an A-B trust plan. The B trust being the trust that holds the exemption amount, and the A trust that may hold this, excuse me, let me take a step back. The B trust will hold the dead spouse's half of the community and perhaps their separate property, at least up to the amount of the exemption. And if it's greater than the exemption, maybe you have a marital deduction trust to hold the excess. And then the surviving spouse's community property and their half of their portion of the separate property is in a survivor's trust. That has been our traditional planning approach to things. We've taken that approach to things because you want to make sure that you carve out and save and protect the deceased spouse's exemption from being taxed when the survivor dies, and by putting it in the exemption trust, it will not be taxed. There may be a secondary reason to have that bypass trust or exempt trust. It's a non-tax reason. It may be simply to ensure that the assets of the dead spouse go the way that the dead spouse wants them to go, notwithstanding what the surviving spouse may do later in life. But oftentimes, I think that difficult discussion with clients about the possibility of remarriage or a spouse going off the rails or becoming very charitable, which can be a difficult discussion, is masked or covered by the fact that you really tell the client, you want this bypass or exempt trust for tax purposes to make sure that you don't have those assets taxed at the first death and also not taxed at the second death. With the exemptions as high as they are, arguably, with portability, you can leave the entire estate to the surviving spouse, and you would think that when the surviving spouse dies, there won't be any tax. And you actually can do that. But in order to do that, you have to file an estate tax return and make the portability election. And the key word there is you have to file the estate tax return. And the client oftentimes will come in, maybe not in estates at the $20 million level, but in a $5 to $10 million estate. And they'll say to you, why do I need to have a bypass trust? Why do I need to have a separate trust holding the decedent's half of the community, as it were, when the total assets are within the exemption of the surviving spouse? And the first thing I've noticed in those discussions is that you now need to confront this issue of what will the surviving spouse do with the assets, and how important it is it that you ensure that those assets be held in a way so that, at least as to the deceased spouse's portion, it goes the way he or she wants it to go. Second, you do need to explain to the client that yes, maybe you can have everything go to the surviving spouse, and if you're comfortable with what the surviving spouse will do with those assets, you don't have to have the bypass trust, but you do need to remind them that assets can go up in value. And it's one thing to address this issue with clients who may be in their late 80s or early 90s, and the types of assets they hold may not appreciate. It's a different discussion when they're in their 50s or 60s or even younger, and there's a potential for appreciation, because at the very least, it seems to me, you need to make them aware of the fact that if they don't elect and file an estate tax return at the death of the first spouse and make the portability election, if the assets go up in value, you may have assets that will be exposed to the estate tax. If you carry this situation over to the situation where the surviving spouse has died now, it seems to me it's very important at that time that you advise the parties again that an estate tax return does need to be filed to make the portability election, unless there's no way it's going to go over. And that, engenders this conversation that I'm going to refer to periodically of how much does it cost to file an estate tax return? And does the surviving spouse, if the return runs anywhere from $10,000 to $25,000, pick a number, is the surviving spouse willing to pay for that when they don't benefit from it? I've had a number of surviving spouses basically say, you know what, my kids will get what they'll get. They're going to get more than I ever got when my parents passed away. I need my cash now. I can't afford to file the return. In the situation where you are confronted with an issue of a desire to ensure that at least at the death, the assets that belong to the surviving spouse, the deceased spouse, will pass the way they want them to pass regardless of what the survivor does, then you have to have trusts. It may be an exemption or bypass trust, and if the amount will go over the exemption, it might be a combination of the exemption and bypass trust with a marital trust. And again, in considering this issue, keep in mind that if gift tax returns have been filed and exemptions have been used up, you may move closer to actually needing a marital deduction trust. And again, in the planning session, you need to advise the clients that in all likelihood, even if no estate tax is due because they are well under the exemption, they really should prepare themselves for filing an estate tax return so that they can at least elect portability if there will be any unused exemption and pass it down to the surviving spouse. But also, and equally important, the marital deduction trust, if there are income tax issues, and we're going to touch upon those in a moment, in order to elect the marital deduction, where you might not otherwise want to elect it so that you get an income tax basis adjustment, which again, I'll come to that in a moment, you need to file an estate tax return. And again, and I'll probably use this example more than once, when the clients come in And they have estates that are between 10 and $15 million and maybe up to $20 million. Oftentimes, there's not a lot of liquidity. And when you say to them, gee, we should file an estate tax return because there are some income tax benefits, both estate and income tax benefits to doing that, and it'll be $25,000, they don't want to do that. Their view, for better or worse, is this is a grand conspiracy between lawyers and accountants to generate fees when none would otherwise be due. And we need to take the time to explain to them that there are some significant tax benefits by filing an estate tax return. And again, let's touch upon those benefits. So let me start again. The basic exclusion amount is now $12,900,000. And for those of you who care, the annual exclusion amount beginning in 2023 is now $17,000. When you have the client in there with you, you do need to explain to them that while no tax is due, they do have an estate plan that may require filing an estate tax return. So there's a bypass trust or an exempt trust set up and a survivor's trust. But they should consider filing an estate tax return. Why? Well, first of all, if the amount of the bypass trust, and let's forget the marital trust for a moment, there's only enough to fund the bypass trust, is $9 million and the exemption is $12,900,000, you've got some unused exemption. And you should file the estate tax return to elect portability so that you can transfer that to the surviving spouse, so that the surviving spouse has that amount, which would be another $3.9 million, to add it to their exemption when they pass away. And while the client may say, oh, don't worry, I'm going to, I've got a $12,900,000 exemption, the surviving spouse says, I won't need that. One, you have no idea what the assets may grow to. And two, keeping in mind the very functional House of Representatives and Senate that we have in Washington, the exemption is scheduled to adjust back in 2026 to an inflation-adjusted figure. I think most people think that's going to be, it's $5 million adjusted by inflation. That may become $7.5 million. But there's a big difference between $7.5 million and $12.9 million. And it's possible that assets may grow in value, and you might want that extra exemption available to shelter those assets. So clearly, from an estate tax point of view, you may want to make the portability election. Now, there's a second issue that I've alluded to earlier that I want to address here. And that issue is income tax basis. Remember that you get a step up in basis to the value, fair market value at the date of death for all community property. I see one question that just come up, but I'm going to hold these till the end. So Steve, if you can keep track of them. You get a step up in income tax basis to the value at the date of death. And you get that if it's community property, not only for the dead spouse's half, but the survivor's half. But if the asset, if when the surviving spouse dies, you have assets that are in the exempt trust, those assets don't get a second basis adjustment, while the assets that are in the survivor's trust and belong to the surviving spouse do get a basis adjustment. And so you can be in a situation where when the second spouse dies, there's no estate tax, and then the children who are the heirs come running in and start whining about having to pay a capital gains tax when some of the assets get disposed of because they were told there are no taxes due. Now, there's a way to solve this problem. And the way to solve this problem, again, is filing an estate tax return and not only elect portability, but perhaps make an election to treat all or a portion of the bypass trust as if it qualified for the marital deduction. And if it does, then it will be included in the surviving spouse's estate, and you will get an income tax basis adjustment for those assets also. So there's an income tax issue that you have to think about here also. Keep in mind that your bypass trust has to be a bypass trust that would qualify for the marital deduction in order for you to make the election in the estate tax return. And the election has to be made in the estate tax return. So for those of you that draft bypass trusts to be very tax efficient and have a sprinkling power without a mandatory payment to the surviving spouse, those won't qualify. And you should think about drafting in a way that actually pays out all the income. I'm probably in the minority, but I think it's a significant minority that always drafts the bypass trust, unless in very large estates, to have a mandatory payout to the surviving spouse. And the reason I do that is a function of explaining all of this to the client. More often than not, when you sit with the client and explain the form of the estate plan to them, the only reason they have trusts, for the most part, is because you told them to do that. And they always ask, well, will I get all the money and will I have control over the asset? And so it's just easier to say to them, you get all the income. And in most estates, unless there's a specific reason, my bypass trusts have that. And that allows that trust to be treated as a Q-tip or a marital deduction trust. But to do that, you have to file an estate tax return. So there are two situations really where you need to have a conversation with the client about filing an estate tax return where you might not otherwise have to file one, so that you can take advantage of both portability and an income tax basis adjustment when the surviving spouse dies. There are also some generation skipping trust issues that you can benefit from with a marital trust and making a reverse Q-tip election that may be helpful in the overall planning. Although again, that may be less important if the estates fall within the $10 to $20 million range. The last point is, I think you end up circling back to the non-tax reason. To the non-tax reason of setting up the bypass or marital trust, which oftentimes is to ensure that the assets that are held for the benefit of the surviving spouse don't end up with a new spouse, maybe all with charity, or get dissipated inappropriately. And in that regard, to some extent, you are actually planning for second marriages. So two comments. One, that's why you have these trusts. That's why you have to have the conversation about making the portability election and making the Q-tip election so that you can ensure you get the maximum exemption of basic exclusion amount available to the surviving spouse, and that you give yourself as much income tax basis adjustment shelter as you can. Do keep in mind that the basic exclusion amount, if someone marries a second spouse and they then die, will be the basic exclusion amount of the last spouse to die. And so if the exemptions go down or more is used up by the second spouse, it may not be as much as you think, but you need to kind of think about that and anticipate and plan for that. So that the conversation really gets to be oftentimes, what do we do? Why are you making me pay 25? And if you got a lot of different assets, maybe it's a $30,000 or $35,000 cost to file an estate tax return. And the surviving spouse says, I don't want to pay that amount of money. Or the kids come in and the kids don't want to pay that amount of money. It is oftentimes, not so much, it's partially penny wise and pound foolish, but partially just not understanding the dynamic. And we've had a couple recently where they didn't file an estate tax return. But in one situation, dad was 92 when he died. Mom was 90. She's still living. The likelihood of significant appreciation in the assets between dad's death and mom's death was not significant, or that they claimed. And they just didn't want to go through the hassle of doing an estate tax return and paying a big fee. You explain it to them, you better do it very carefully in a letter so that everybody understands the choice they're making, and that we did not file a return to elect portability or for purposes of the basis adjustment. I've had smaller estates, ones that are under $6 million. I don't see us going back to basic exclusion amounts of $3.5 million. So if they, and they didn't really have assets that would go up in value. And they also, the trustee said, the trustor, the surviving spouse trustor and trustee said, I don't have $25,000 to spend now to do an estate tax return. And if my kids have to pay a little capital gains tax, so be it. Again, be careful with that and document it. The last point I wanted to make is, what do you do if, in fact, the family, one of two things happened. The family understood that there was no estate tax liability, was not sophisticated or needed to deal with some of the income tax issues we're going to discuss, and did nothing. Or relied on the advice of an accountant that said you don't have to do anything. Or second situation, they go to the accountant and the accountant, no return is required, but the accountant attempts to deal with portability or making the Q-tip election and screws it up. Is there a remedy? And the good news is that there is. Where an estate tax return is not required to be filed, you have two revenue procedures, Revenue Procedure 2017-34 and Revenue Procedure 2022-32, both of which are cited on page 2 in the outline in the middle, which give a really abbreviated procedure to file something with the Internal Revenue Service and correct, either make the election by filing a return you didn't file, or correct the election, the elections that were made, so that you make the proper portability and or Q-tip election. If you were required to file an estate tax return and it just got screwed up, then there's also a revenue ruling procedure that you can rely on. It's a more difficult procedure and it's an expensive procedure. But again, it may be well worth it. People are apoplectic if they have to pay $30,000 or $40,000 for a private letter ruling. But the amount of money you can be talking about in terms of saving can be, 10 and 20 times that amount, and not always that far off in the future. So the sum and substance of this first part of the presentation, which was really the genesis for doing this, was the fact that there is no estate tax due doesn't mean you turn off the lights. It's often been said of me that the lights are on, but nobody's home. Can't afford to have that happen here. You need to be aware of the fact that while theoretically changes in the law which increased the exemptions and freed people from being subject to an estate tax liability, actually in many respects made the tax planning more complicated rather than less complicated, and made much of the tax planning income tax planning as opposed to estate tax planning. And, you know, I will make this perhaps horrible political observation, but you know, if you have an estate that's $15 million and up, you're getting close to the top 1%. And the tax system seeks to impose something on you, and you need to be aware that it'll get you one way or the other and be able to plan for it. So that was the first thing I primarily wanted to cover, because that's what I have seen a lot in the last couple of years, with people just not understanding that the fact that there is no estate tax return required and no estate tax due, especially after the death of a first spouse, doesn't mean you shut it down. You thought you could dance, but you can't. You really have to make sure you cover the income tax issues too. Now, what I'd like to cover in the second part are some related income tax issues to think about. Again, even though you don't have any estate tax due. And in this regard, keep in mind that even though there may be no estate tax due, under the terms of the estate planning documents, you may still be setting up separate subtrusts in a marital situation when one spouse dies. And even if it's a single spouse situation, between the nature of the assets and the timing in terms of making distribution of that trust, especially if there's any litigation or disputes in the trust administration, and the time you make distribution, there are some income tax issues that need to be dealt with. And so I wanted to just, over maybe the next 12 minutes, and then we'll leave some time for questions, mention some of those issues. The first one is a 754 election. This has to do with partnerships that are in an estate. And oftentimes people forget that while for estate tax purposes, you do get an income tax basis adjustment when a partner dies, that income tax basis adjustment is an increase in the value of the partnership interest. So while the value of the partnership interest may get a step up in basis, it doesn't provide a step up in basis for the underlying assets that are owned by the partnership, such as when they are sold, there still could be a capital gain at that level, which gets passed through to the partners. Now, the service provides, the Internal Revenue Code actually provides a remedy to that, and that is known as a 754 election under Internal Revenue Code 754. And that election allows you to step up the basis of the assets that are attributable to the deceased partner, so that inside the partnership, you end up getting a separate set of books and records. And the cost basis for the deceased partner is adjusted to the fair market value at the date of death. Oftentimes in very large partnerships, it's difficult to get the partnership to make a 754 election. And sometimes partners don't want to do it because it can be an added accounting expense. But you should be aware that once a 754 election is made at the partnership level, it's available going forward for all deceased partners. But it's an important thing to think about when you have partnership interests in a decedent's estate, because again, it's an income tax issue and can save significant capital gains. And in addition, when you get that basis adjustment, you get a new inside basis for that partner to depreciate. And that may provide some shelter for the income that's being distributed to the partner from the partnership. the next election, or the next topic, is what is known as a Section 64, IRC Section 645 election. Now, this is an election that's available for a qualified revocable trust and the executor of the decedent's estate to make an election to have them treated as one entity. And it does not matter if an executor has actually been appointed. But if you make the Section 645 election, then the trust essentially can file as if it were an estate. And that can have a number of benefits. If you're a trust, you're going to end up having a calendar year. But if you are an estate, you can elect a fiscal year. And while ultimately it catches up with you when the estate closes, it may allow for some deferral over a period of time. The outline at page 4 discusses a number of issues that relate to making that election. But you can see that for purposes of certain expense deductions for the subchapter S election that will have to be made, in terms of making estimated payments, you can see that there may be some significant benefits to making that election. Now, again, let's not lose sight of what we're talking about. We could be talking about an estate that's between $15 and $20 million. And whether or not they choose to file an income tax return, an estate tax return, to elect portability or to make a Q-tip election. Let's assume all of the comments that I made in the first 25 minutes of this, they could care less about. They're mad at me because of my joke. Who knows? But you still have income tax issues that you have to deal with. And you know, this is really getting into the weeds. And depending upon the sophistication of the accountant, it just may not get picked up. But these can be elections that are important to make because they can have some income tax savings and benefits that people don't think about because the tax lever has been turned off because they think there's no estate tax that's due. Now, I will share with you a comment that I've had a couple of accountants make to me with regard to making the election. And the comment is simply this: I get it. But one, it catches up to you at some point. So unless you have something specific that you want to defer for as long as you can, and it results in a significant number, between the fact that the savings may not be that great and there aren't other issues that you will benefit from in filing the return, they will simply say the cost of doing the estate tax return and the related analysis offsets the benefit of making the election. And the only point that I would make is you just want to have that conversation. Don't forget about this. It's like it should be on your checklist or your inventory of things to review in involving the accountant in the process. While my experience is that sometimes it's asking too much from all accountants to be have full knowledge of all the nuances of the federal estate tax. They are really good at these kinds of issues. And so it's worth the drill of talking with the accountant to see if they are aware of anything, because you remember, in all likelihood, they've been doing these people's returns for a long time, of any benefit that may occur from making this kind of election. I wanted to mention on page 6, IRC section 642C. I don't know how often that will arise, but you need to be aware of it in terms of the charitable deduction that might be available on the income tax return. The next item is kind of related to some extent to the 645 election to be treated as an estate. It's not directly related to it, but it's kind of indirectly related. It's this ongoing discussion that you have about whether or not to take a deduction on an income tax return or an estate tax return. Are the expenses deductible on the estate tax return? And where do you get more bang for your buck? And again, this is a situation where even if no estate tax return is due or going to be filed, because they don't want to fiddle with portability, they don't want to fiddle with the Q-tip election. You may want to think about whether you're better off with deductions on the income tax return or on the estate tax return, because these deductions impact not only the income tax, but they may impact the allocation of assets among the trusts. Now, if you're not paying any tax and you're at a very low level, you're just going to take them on the estate tax return, even if you file it. You're going to take them on the estate fiduciary income tax return, even if you're going to file an estate tax return. But think about it. And then the last topic I wanted to just mention, and this is probably the most remote in terms of thinking about it, but it's worth considering, and that is the interplay of taking how depreciation is taken. Because while depreciation may have the same impact for income tax purposes, it can have a substantive impact on what's distributed out from a trust as opposed to retain in the trust for a reserve being set up for amortization or depreciation. If a trust lasts long enough, building up those assets in the trust can have a very positive impact on the ability to continue to maintain and take care of assets. And I mention this probably as much in the context of disputes as anything else, because oftentimes, if you have in particular assets that may have been subject to, I don't know how the obsolescence, perhaps they haven't been kept up in the manner that they should have been kept up. And the surviving spouse is not the mother of the remainder beneficiaries of a bypass trust. You have a real issue there. And while the decision maybe is made by the trustee because they have the authority under the California Principal and Income Act, and all of this is discussed in pages 7 and 8 of the outline. If you're representing a beneficiary, you may very well want to look at this and make sure that an adequate reserve is being set up for depreciation. Because when stepmom dies or stepdad dies, and the children are now inheriting a building that's a piece of crap because it hasn't been maintained, at the very least, they might want to know that there's some reserve, tangible reserve there that's available to deal with that obsolescence. So this isn't so much a tax issue as an issue. It's a conceptual tax issue, but it's a substantive issue of an income tax issue that you ought to think about, because it can have a significant impact in certain situations in terms of the income beneficiary and the remainder beneficiary. So to conclude, and before I tell my final joke, I'm not sure that I've given you God's gift to dealing with this particular topic. But what I wanted to accomplish was to simply remind everyone that just because there is no estate tax due, you don't shut the lights off. In fact, if anything, because there is no estate tax that may be due because of the size of the exemptions, you really have to dig down and make sure that you've considered all of the other issues that could be impacted by the decisions that you make. These can include shortchanging the surviving spouse's estate from having the maximum amount that might be available to shelter those assets from tax because of portability. by getting the maximum income tax basis adjustment on assets that will be probably disposed of at the death of the surviving spouse, and by making the kinds of tax elections that will benefit the surviving spouse or other income beneficiaries during the life of the trust. And if you screwed something up, or not you, because all the people attending this are the best of the best in terms of practitioners, but if the people who come to see you have this problem pop up, there are solutions. And the two revenue procedures really give you a lot of time. The 2022-36 revenue procedure gives you up to 5 years to kind of correct it with that easy procedure. So there are ways to kind of go back and check with people and see if they've done what they should do, and if they didn't, there's a solution. And as a professional, you may provide them a real benefit by giving them that solution. So before we go to questions, let me tell one more short story. A nice, calm, and respectable lady went into the pharmacy and walked up to the pharmacist and said, "I'd like to buy some cyanide." The pharmacist asked, "Why in the world do you need cyanide?" And the lady, the nice, respectable lady, replied, "I need it to poison my husband." The pharmacist's eyes got big and he explained, "Lord have mercy, I can't give you cyanide to kill your husband. That's against the law. I'll lose my license. They'll throw both of us in jail. All kinds of bad things will happen." Absolutely not. You cannot have the cyanide. Just get a divorce. The lady reached into her purse and pulled out a picture of her husband in bed with the pharmacist's wife. The pharmacist looked at the picture and said, "Oh, you didn't tell me you had a prescription." And with that, if there are some questions, I'll see if I can answer them.
So Allan, there are two questions. They wrote to everybody, so you may see them as well. Do you want me to read them, or can you see them?
Let me see if I can pull them up.
Okay. I can do it. I can do it.
Okay.
So, all right. The first question is, does portability give the survivor the entire exemption amount available to the deceased spouse, or only the amount equal to the value of assets reported on the return?
Well, it doesn't quite work that way. The amount that is ported is the unused amount of the exemption. So if you use some of the exemption to shelter a bypass trust, you put it in a bypass trust. But if the exemption is $12.9 million and the amount that goes into the bypass trust is $9 million, there's $3.9 million of unused exemption. And that is what is ported or transferred to the surviving spouse. On the other hand, if either the assets of the dead spouse are left all to the surviving spouse, or if everything that was in the deceased spouse's estate goes into a bypass trust, but you make the Q-tip election so that you don't use up any of the exemption to shelter the tax in the dead spouse's estate, then the full amount of the exemption is ported. And the last comment I would make is that whatever is ported is what's ported. And if the exemptions drop in the future to 7.5 million, you still get that 7.5 million plus whatever's been ported or transferred.
Okay, the second and before I go on to the second question, I just want to say that one of our committee members, Jane, wrote to you, "Allan, superb job, great review of all the checklists, and yes, your jokes are funny."
That means somebody's going to get flowers later.
All right, here's the second and probably last question we have time for. Have you seen any problem Q-tipping an all-income bypass trust in older forms? Is an example where the marital deduction savings clause doesn't say it applies to the bypass trust as well.
So if you had an income bypass trust and you don't have a savings clause, but it otherwise qualifies for the marital deduction, you shouldn't have a problem Q-tipping it. I guess if you had one in an older form where you might have some provisions that might limit the ability to qualify for the marital deduction, you might have a problem Q-tipping. But California, the probate code has a specific provision that allows for reformation of marital trust to qualify, and you might rely on that to fix it, and then you could Q-tip it.
All right, one last question came in while we were chatting. So many years ago, they heard that a 706 filed exclusively for the Q-tip election can be filed at any time. Is that correct?
No.
Okay.
You've got to timely file it, and if you don't timely file it, then you've got to look to the revenue procedures in order to get it filed. The procedures essentially give you, you're asking for an extension of time to file it, and that's how you file it.
Okay. And there's one question about the outline. So I'll just remind everybody, you should have received an email today from Karen Friedman that had a reminder of the program and Allan's outline in it. If you did not get that, please let me know or let Karen know and we'll send you the outline. Allan, thank you so much for your presentation.
I made a note in connection with the article of Keith Schiller in the footnote in the first page, and I did sensitive to the copyright issues. I did speak with Keith yesterday, and I did have permission from him to include that.
Thank you. So thank you for your presentation, Allan. Thank you all for being here. I want to remind everybody that 2 weeks from today, we'll have our next presentation. Daniel Lorenzen of Venable will be speaking about slat trusts, Yellow Brick Road, or Trap for the Unwary. I love these clever titles. And please, as we get to year end, if you have clients that want to take advantage of some tax planning through charitable giving, Dan, Mattel, and myself are all available to you to help you with any of that, yourself, your clients. And Allan, I can't thank you enough again for your presentation, taking the time to put it together and presenting for us today, and for your work on the committee that puts this all together. So with that, I wish you all a great day, and I'll see you in 2 weeks when we start again.